everyone, and welcome to our channel Finance Oak. Today we'll be discussing call. Call is a kind of financial instrument that provides the option buyer the right to buy the underlying asset at the expiry at predetermined price, which is also known as strike price. Call is also a belief by the investor that the market will rise, because that is why the option buyer is undertaking the options contract to purchase a higher value commodity at a predetermined price in order to gain from the market. Call gives the buyer the right to buy from the seller but not an obligation. There are two kinds of positions under call, namely long and short. Long call. Under this, the option buyer undertakes a long position, that is, he buys the call option and pays a certain amount of premium to the option buyer, and therefore the investor gets the right to buy the underlying asset. Let us understand this with the help of an example. Say A took a long position by purchasing a call at say 100 strike with a premium of 10. The current spot price of that security is at say 90 and the expiry is after a month. So when would the buyer or A exercise his right, as he has the right but not the obligation to buy it, used to happen in forwards and futures. The buyer will exercise his option when the price at the expiry is greater than the strike price, that is 100 in this case. This is because the buyer will have the right to buy an asset of more value at a lower price. The break-even point occurs at 110, that is the strike price plus the premium paid. So if the price at expiry is 100, the buyer loses his premium amount. At 110, he is in no profit and no loss, and at a price above 100, he makes a profit. The main advantage of this type of position is that the loss is limited to the premium paid, whereas the returns are unlimited. This strategy is used by the investor who is very aggressive and thinks that the market will be performing in a bullish manner. Short call. It is an obligation for the option seller to sell the underlying security at the expiry at the predetermined strike price. In this option, premium paid by the buyer is received by the seller, and he is obliged to pay the premium if option is exercised by the option buyer. In this strategy, the investor receives net premium, which is the maximum profit, and losses are potentially unlimited, and hence it is a risky strategy. This is undertaken by the investor who is bearish about the market and thinks the market will fall and tries to benefit from the downside trend. Thank you.